Hey guys, Adam Rose, Vice President, Senior Loan Officer here at Western Ohio Mortgage in Sydney, Ohio. This is another episode of the Mortgage Guy Podcast, and today you're going to get to learn about the FHA 203k, which is another piece or the second segment of our renovation series. And last week I talked about USDA renovation, and this week I get to have Teresa Rose, our President and owner of Western Ohio Mortgage, on, who is also certified to teach a class in FHA 203k renovation financing. But we're going to kind of continue this segment a little bit here. To kind of give you a little bit of the differences. You got kind of like a baseline from last week on USDA Reno and FHA, how it differs, some additional things that you can do. And I'm just glad we have Teresa on here because I've been playing a golf outing all day and I just want to go to bed. So T-Bomb's on. T, thanks for coming on. I really appreciate it. All right. So first thing I want to jump into is, first off, the different types of renovation loans with FHA, because we have something called a streamline, and then we also have something called a standard.
Right.
Sorry.
Right.
Limited and standard.
Right. Streamline's what they used to call it.
Right.
Right.
Yeah. So, I mean, what's the primary differences between the two?
So the standard K is a full renovation where numerous contractors may be involved. Mm-hmm. Numerous things are being done to the property. You could be adding on a room. You could be just doing a complete reno job on the property versus the limited, which is generally 2 to 3 specialty contractors. Maybe you just need to put on a new roof and update the HVAC. Those 2 specialty contractors would fall within the guise of the limited. It does have a maximum amount on the reno part. Mm-hmm. Today, as we're recording this, is $35,000.
$35,000, that's correct.
It's going to $50,000. We're just waiting for the formal announcement to come out from HUD. It would be great if it went to $75,000. That's not likely. I think $50,000 is where we're going to be coming in at, because with the cost of everything being as high as it is now, $50,000 still is only going to get you probably a roof and a new HVAC, maybe one other item. Mm-hmm. But if you have
a couple
ringing $100,000 of repairs, you could do that with the full K.
All right. So we got the differences between the two. It's very, very limited in regards to, so like the limited K is 35 right now, maybe shooting to 50.
Right.
One other major difference between the two is depending on the type of work that you're doing. Right.
That's right.
So limited is pretty much you can do whatever you want. However, if you exceed $35,000 in renovations, it kicks automatically to a full, or if you're doing anything structural.
If the word foundation is anywhere in the description of the work to be done, you know you're doing a full. And again, it's going to go to 50 very soon.
So structural, but also if you're changing the footprint of the home.
That's right.
Right? We're talking, everybody wants to think foundation. We're talking if you're tearing down walls, adding walls. Mm-hmm. That's changing your footprint of the house.
That's right.
Right? So let's talk about, let's say it kicks into a full K. What's the difference between a full K and a streamline K, other than what you can do to the property? And, obviously with a full K, you can practically add whatever you want to it. We've done $250,000 renovation loans where the renovation piece is $250,000, right? But the consultant specifically is what I want to touch on that.
So when you're doing a full K, you could move your house. There are so many things you can do with a full K, but the difference is that in addition to getting estimates from a contractor, and with the full K, you're going to need a general contractor who's going to manage the project, and it can't be the homeowner. Right. There's no self-help. In addition to that, there's going to be a consultant who is approved by HUD to provide basically what's like a second opinion of the work that's going to be done, to make sure that the work can be done for the dollar amounts that have been quoted, and that everything that needs to be done in order for the property to meet HUD minimum property requirements is included. Because sometimes, for example, if you're doing a full K, you're generally going to have hardwired smoke detectors in the house. A lot of people don't know that. You don't need that on a limited, but if you go full K, you didn't think about, well, I want hardwired smoke detectors. The consultant's going to add that in his quote and tell the contractor to bid that. So those are the types of things that consultant is going to do for you.
I think on a full K, we get a lot of questions on adding detached outbuildings or garages. Mm-hmm. Is that allowed on a full K?
You can now. Now, there was a time when it had to be attached, but you can now do a detached garage, not a pole barn, not a barn, but a garage.
And what kind of, with these, the biggest wrench with these guys with renovations, as we touched on last week, is your curveball, or your wrench, as I like to say, is your contractor.
Yes.
Here's the nice thing about Full K. Having the 203k consultant involved in the project is actually quite helpful. Yes, to the borrower, it is a touch bit more expensive in regards to closing costs and the expenses to do the loan, but we have someone managing the contractors, someone managing the project outside of the lender and the borrower themselves. And there's some accountability there.
And keep in mind that when you're doing a Full K, you're operating on draws, just like you do
like
with
a
construction. Right.
Yeah.
So the money's not just all thrown out there. It's placed in escrow and it's released as certain stages are complete. That consultant's going to go out and make sure that the contractor is to the stage that he is supposed to be at when that draw is released, so that no one gets more money than they should. They also require a holdback of 10% of each of those draws until everything is complete. So that helps to protect the homeowner against a contractor who either didn't do a good job, didn't complete everything the way he was supposed to. None of the final funds are released until everything is done the way it's supposed to be.
Right. So here's the big benefit of FHA 203k in my mind. So I love USDA Renovation. It's my favorite program because we hold the monies here. It's a lot easier to disperse, a lot easier to manage. Mm-hmm. However, people, the biggest problem child properties are not in rural areas typically. No. They are usually in large metropolitan areas. Would you agree with that statement? Yeah. In general. And those properties need a lot of love and care. Mm-hmm. You see that listing, it always says little TLC needed to bring this property up to par. This is where this program comes into play. USC is not eligible in those areas typically if you're in a population zone of 20,000 people or more. Therefore, the FHA 203k is a great program. And to bring these properties up to par, because a lot of times they need new roof, they need new HVAC, they need new windows. Similar to that. Here's
the other really important thing to remember. So many borrowers right now are having a hard time competing with cash.
Yeah. Mm-hmm.
And when properties have deferred maintenance, they're really having trouble competing with property flippers that want to go in and flip the house.
Well, because sellers know they don't want to do anything to the property. They're like, listen, I'm not going to have an owner-occupied come in here with government lending because I'm not doing any repairs to it. But the cash offers are usually less than what the asking price is. This is key.
So the way you're going to compete with that is a lot of these gems are out there, and with a little bit of TLC, they could be the perfect house for you. And the way you can compete with that cash offer or that property flipper is you can offer more.
Yeah.
You can offer, because they do customarily offer less when they're offering cash. And the other great thing about the standard K is that you're going to get 110%. So instead of being pigeonholed into an as improved appraisal that might not give you the value you need in order to make this deal work, you get an extra 10% added on top of it. So there's very little, if any, risk that you're not going to appraise out in those situations. So it does give you that latitude. That's why the K is a real important tool in this market to be able to compete with those offers.
Yeah, I think we actually mentioned that in last week's podcast. So to bring you up to date, if you guys didn't check it out, when we're talking about the extra 10%, so the appraiser is actually going to get all the renovation estimates that you've gotten from your contractors, or if we're using a 203k consultant, they're going to assist in that as well. So the appraiser gets these estimates, and they're actually going to go out to property and appraise this home, assuming all these repairs are already completed, right? So they're going to give you the after improved value, which is going to give us enough room to typically finance all these repairs in. So we very, very rarely run into any kind of issue with these appraisals or coming up short in order to finance these renovation costs in, which is a huge plus to the buyer. But like Teresa was saying, when you're in these large metropolitan areas and we're going FHA, it is hard to compete with cash offers. But remember, these cash offers, a lot of times they are offering under the ask because they feel they need to get a little benefit for offering a no-hassle transaction to the seller. So they expect a discount. Now, you as a buyer coming in with government lending, you can also have that leg up if that seller's waiting to wait just a touch bit longer to close, right? A 35 or a 45-day closing contract instead of a 2 or 3 week closing window, and maybe net themselves $5,000 more, $10,000 more, or something like that. To me, as a seller, that would be worth the wait.
For certain. Yeah,
right?
that's what we tell, real estate professionals. A lot of times they hear the word 203k and they cringe because there's a lot.
I cringe a little bit when I hear it.
There is more work involved, but it's worth the reward that you get, right? And we've tried to emphasize to our referral partners, listen, you're going to get additional money for your seller. That's what your job is, right? To get the maximum dollar you can for your seller when you're representing as a listing agent. So why wouldn't you want to wait a little bit longer to get maybe $20,000 more than you would get
absolutely
on a cash offer? The other tip that I want to give everyone is HUD, when there's not a lot of REOs right now, meaning foreclosed HUD inventory, because foreclosures are down at the present time. Mm-hmm. However, if you go to, I believe it's, the HUD store or HUD.gov, you can find your foreclosed properties. They're open to accepting offers from borrowers with 203k because, first of all, their inventory is always open first to owner occupants before it is to any property flipper or anyone who's going to purchase it as an investment property. So not only is that inventory first offered to an owner occupant, they're always willing to take 203k financing because it's their product. That's their part of their mission. So that is a great way to beat, again, the competition by looking at those websites to see if you can find something there that's already being offered by HUD.
Yep. So we're out shopping. Okay, I'm a buyer, and I'm okay with renovation. I kind of understand how the program works. I have a contractor. Are there any restrictions on the property type?
So you can do condos,
Mm-hmm.
1 to 4 family. Of course, you got to be living in at least one of the units. HUD REOs, just for people who are aware, you can actually be an investor and finance a HUD REO with FHA. But but you can't do a 203k as an investor. So we don't do those.
You didn't hear that.
But you can do them. But if you're ever doing research and you're saying, wait, it looks like it's open to investors, you cannot do 203ks with that. So as far as restrictions go, you can't do luxury items. So you can't put in a swimming pool. You can fill one in, but you can't put one in.
Yeah.
You can't do, the big outdoor kitchen, fancy outdoor barbecue pit situation.
If you can afford that, you can pay for it yourself.
That's right. It's not a luxury item. It's for minimum property requirements. Doesn't mean you can't have nice stuff. And the other thing that people forget on the standard, and we always recommend this to our clients when they're doing a large project and they're trying to come in with budget, there is a contingency reserve requirement on this product. Let's say it's 10%. Okay. If you're doing a $200,000 reno,
that's $20,000.
That's $20,000. That's right. So a lot of times people will have a list of wish items, and we encourage them to kind of hold those back. So let's say you want all brand new appliances, okay? And they're going to be $5,000, okay? Don't put that in your reno bid. Keep that as a wish item, because as long as all of the health and safety issues are taken care of within the project, when you get toward the end, you can ask for a change order and tap into that contingency reserve and buy the appliances out of that.
Right. It's better because if you add the $5,000 up front, now we're putting a contingency reserve on top of said $5,000.
And if you don't use all the money, it's going to go to principal.
Yeah,
I mean,
it doesn't get wasted.
It doesn't get wasted, but there's no point in increasing your loan amount unnecessarily, right? Mm-hmm. Because what happens is, even though it goes to principal, your payment was still based on that higher loan amount. So we do encourage borrowers to really think through their project and make sure that if there are some things that they can live without but they'd like to have, maybe they decide they'd like to have granite countertops instead of, the basic counters, or there's some other, maybe they want to upgrade their flooring. They can do that with a change order on the full K. You can't do that on the limited, but you can on the full K and take full advantage of all the dollars that you have available to you.
Yeah. It's a great program. It's just like a construction program and just bringing houses to par. So we talked about property eligibility. So let's talk about purchase versus refi. A lot of times, guys, this is used as a purchase program. That's how it's utilized most. However, a lot of people aren't aware that you can use it in a refinance. So you own your existing home. You want to stay. You have I don't know. It doesn't matter what the rate is. Let's not talk about rates. All right, we're not touching on that. So, but you need a $60,000 renovation project with a new kitchen, new whatever you're doing to the home, and you don't want to put it on the Lowe's card, right? That's 25%. You don't want to get a second mortgage. That's 13%. What do? Well, FHA 203k, right? It's think of cash out refi, but it's in a renovation loan, right? So we're not as limited as a cash out refinance. Nice thing about cash out, you can use the money for whatever you want, use it as cash. However, you are limited to 80% of your loan to value, 80% of your home's value, right? So it puts limitations on there where FHA 203k refinances are, correct me if I'm wrong, treated as if you were doing the purchase. You were able to tap into a lot more of your equity position and use that as the renovation. So, I mean,
it depends on how long you've owned it. So if it's less than 12 months, it's going to be your existing debt or the as-is value. If you've had it longer than that, that's when you can tap in.
So are there any other special weird things about the FHA 203k refinance that we need to know about?
There's not weird things.
Other than speak into the mic.
It works like a refinance. I'm looking at my notes here to see if there's anything off the top of my head that's weird about it. And other than the way the mortgage amount is calculated, you can do the same type of work, and they have the same prohibitions, like no new swimming pools or anything like that. But I don't think so. Yeah, I don't think so.
Yeah, and we've done a handful of them. We've had people wanting to put on a deck. That's allowed.
Yes.
Don't tell me it's not allowed because I've done it.
Patios.
Very good. Mm-hmm. So patios, decks, outdoor living, that style of thing. Again, no pools, no outdoor kitchens. Mm-hmm. But a lot of people use it for upgrading their kitchen. Kitchen's always number one, I feel like. Mm-hmm. Kitchen, bathrooms number two, and a little bit of outdoor living space.
And there are pickups for energy efficient items, but it goes a lot farther than I can discuss in here. Right. But just know that if you were doing some very specific energy efficient upgrades, that you get some additional boost there as well. Yeah.
I mean, this whole thing's a broad brushstroke, guys.
Yes.
It's just giving you some generalities to make you a little bit more dangerous in the market for the real estate agents, to help you putting in better offers, make you more educated about your options. And that's the big thing here. The last thing I wanted to touch on is with 203k financing, and we barely mentioned it. There are some fee differences, cost differences with this program compared to a straight purchase. Mm-hmm. Is that something you want to dive into a little bit and kind of explain those differences?
So if you're doing a full K, you do have to pay a consultant's fee.
Correct.
It's based on the size of the project. It's all financeable, though, that entire fee. Generally speaking, if you're going to do what's called a feasibility study, you have to give a consultant part of that payment up front. Yep. You'll get the rest of it. It'll come back to you in the financing.
I've found that most consultants are charging about $400.
Right. They because it is a lot of work for them, and they don't want to do all the work, and then you decide, I've just changed my mind. I'm not going through this project. Right. And they don't get paid for any of the work that they've done.
So I want you to think of this, guys. When you're out shopping for a house and you know it's going to need a renovation, you're going to go FHA 203k. I want you to think of this consultant fee as your inspection, because that's exactly what it is. Okay. They can replace your whole house inspection. They will inspect said property. Okay. Most of them are already whole house inspectors that went ahead and took that extra leap in getting licensed for 203k consulting. So I highly suggest that you're not going to go out and spend $400 on a whole house inspection, and then we're going to call the consultant back out there for another $400 fee so they can tell you what's wrong with it and what needs to be brought up to par. Use your consultant for that, okay? So it is more expensive of a loan program because we're just so used to buyers paying for the inspections out of pocket to the inspector, not to something that's involved with the transaction in regards on the lending side.
Right.
So swap that out, all right? That's called a wash here in my mind.
It is.
All right, it's a wash. So that's one big thing. There are some tiny additional fees like the origination charge in regards to the escrow management. Other than that, a slight appraisal adjustment. I think it's a $50 difference in appraisal costs. Is there anything else that you can think of that I'm missing?
Just a couple notes. So the contractor does need to be approved by the lender. So on a full K, we need their resume. We need to see this is not the first project they've ever done. We need some trade references because we don't want these projects done by, as we call, Johnny truck and a ladder, because just because you can, make some home repairs does not mean that you necessarily could add on a room or do any kind of structural improvement that might fall under the guise of a full K, right? So we do want to know that those people are qualified. We don't want people doing their own work. There's a reason for that. If you're working a full-time job and you've got a 6-month project, which we failed to mention that you generally get 6 months on these projects, they're extending that with the new guides. I think it's going to, I don't want to misspeak here. I think it's going to 9 months, but I don't want to say for sure because I don't recall, but it's coming out in case somebody's watching this after the new guidelines come out. But if you're working a full-time job and then you say, hey, I'm also going to do my $200,000 reno or my $50,000 reno, the likelihood that you can finish that within the time frame allotted and that you have the tools and that you have the experience to do it are slim. And that's why lenders don't allow self-help. HUD's got a provision for you to do some self-help items, but the majority of lenders, including us, we do not allow it for that reason. So, and you want to make sure that, you're dealing with someone that you can trust, because these projects can go sideways. You can't change your mind in the middle. I'll give you a perfect example. We had a property doing a full K that they had plans to add a half bath. I think it was a closet and they were adding the half bath, but at any rate, the money for the half bath was included in the full K and the appraisal was done as if it had this extra half bath.
Right.
The consultant goes out to do an inspection to release some funds, and lo and behold, it's not a half bath, it's a closet. And they said, well, we just decided we're just going to make it a closet. Well, the problem with that is you were appraised as if you had a half bath.
Change the value, guys.
You changes
the comps.
Changed everything. So you can't just take it upon yourself to make those changes once that, you can do changes throughout the project and say, hey, I want to add this or I want to do this.
More upgrading.
Right. But you can't just do this without permission, without that change order up front to make sure that we know that the value is still there and that everyone's paid the way they're supposed to be. So that's the other thing to keep in mind. You do have a lot of latitude, but it's not, let me just do whatever I want with the money. It doesn't work like that.
Yeah, I wish that was the way it was,
yeah,
right?
It's not.
That'd be great.
Mm-hmm.
Again, guys, if there was a perfect product, there would only be one. So there's always pluses and minuses to everything. You just can't do it yourself, even though everybody thinks that they're Bob Vila. I blame DIY Network, right? And HGTV. Everybody thinks they can do it themselves. That's really all I got. You got anything that you want to hit me with, T, that we think we should educate people about?
I don't think so. I can't say enough about 203K. Definitely be considering this in the market where the competition is stiff. We are starting to see more inventory, but if you're trying to compete again, if you want to stay in a price range that's more affordable and you're trying to compete against people who have cash, this is the route to consider. There's
a lot more crappy inventory out there, I can tell you that. Yeah. So, very good, guys. I appreciate you guys listening to us. Hopefully it was very, very helpful and informative. Of course, this is a broad brushstroke on this program and how it works and how it operates. There's so much more to it, and we'd be happy to kind of guide you through it and what you need to do next if you are entertaining a renovation program or project on your existing home or on your next purchase. So make sure you guys subscribe to our YouTube channel to follow up with updates or for updates, and check us out on Apple Podcasts and Spotify, and we will see you all next week.